Shield your wealth from inflation's grip. Discover essential assets to fortify your financial future. Don't miss out. Hey there, financial enthusiasts. Welcome back to our channel, where we delve into the world of smart investments and financial strategies. Today, we've got a topic that's as crucial as it is intriguing. Keep your money away from inflation. Own these assets now. You see, that dollar in your pocket won't stretch as far in a decade due to the lurking beast known as inflation. But don't worry, we've got your back with a treasure trove of insights on how to shield your wealth against its ravages. So let's dive into the world of finance, inflation, and savvy investments. Number 1, gold. Often regarded as a hedge against inflation, gold has a historical allure as a safe haven in times of economic uncertainty. While it's not a perfect shield, its tangible nature and reputation as an alternative currency make it a go-to choice. However, during periods of rising interest rates, gold's lack of yield can dull its shine. Consider the SPDR Gold Shares ETF for exposure. Remember, while gold's luster may fade in certain scenarios, its enduring value and role as a store of wealth make it an asset to consider in your arsenal against inflation's relentless erosion. Number 2, commodities. Next up, we have the world of commodities. These diverse resources, from metals to energy sources, have a unique knack for predicting inflation's rise. As their prices surge, so do the costs of products they contribute to. Commodities offer a dynamic way to ride the inflation wave. You can tap into this potential via exchange-traded funds like the iShares S&P GSCI Commodity Index Trust. Just remember, while commodities can be a powerful ally, their volatility demands careful consideration. So, prepare to harness their potential and surge ahead in your quest to shield your wealth from inflation's erosive tide. Number 3, 60/40 Stock Bond Portfolio. The 60/40 Stock Bond Portfolio is a classic strategy to weather financial storms. This mix combines the growth potential of stocks with the stability of bonds, creating a safety net in turbulent times. While the 60/40 portfolio may lag behind an all-stock approach over the long term, it provides a buffer against market volatility. If you're interested in this strategy but seek convenience, the Dimensional DFA Global Allocation 60/40 portfolio could be a valuable consideration. However, remember that, compared to an all-equity portfolio, the 60/40 approach might yield lower returns. Yet, this trade-off could be well worth it for the peace of mind it offers during inflationary periods. So consider the 60/40th portfolio as your armor against the erosive effects of inflation, keeping your wealth fortified and secure. Number 4, real estate investment trusts. Let's step into the world of real estate investment trusts, where building wealth meets bricks and mortar. REITs are companies that own and operate income-generating real estate properties, and they thrive when inflation drives up property values and rental income. By investing in REITs, you gain exposure to the real estate market without having to manage properties directly. Consider the Vanguard Real Estate ETF for broad exposure with a low expense ratio. However, keep in mind that REITs have their nuances. They're sensitive to interest rate fluctuations, and taxes on their dividends can be higher than average. Additionally, REITs have expenses like property taxes that can affect cash flows. Balancing the potential rewards with these considerations can help you make an informed decision about including REITs as part of your arsenal against inflation's erosive impact on your financial fortress. Number 5, S&P 500. Time to ride the exciting wave of the S&P 500. This index houses the heavyweights of technology and communication services, which comprise around 35% of its composition. These sectors, known for their capital-light nature, make them potential winners in the face of inflation. Investing in the S&P 500 or an ETF tracking it, like the SPDR S&P 500 ETF, can position you to capitalize on these industry giants. Yet, like any investment, there are considerations to keep in mind. The influence of market cap giants can overshadow smaller players, and the index lacks exposure to high-returning small-cap companies. While the S&P 500 offers the promise of growth, Striking the right balance between large cap and smaller cap exposure is key to leveraging its potential as a powerful hedge against inflation's erosive effects on your wealth. Number 6, real estate income. Real estate income is another gem in our arsenal. As inflation causes property values and rents to rise, landlords benefit from increased rental income over time. This steady stream of cash flow can be a powerful hedge against inflation's erosive effects on wealth. However, it's important to note that investing in real estate comes with its own set of considerations. Transaction costs can be substantial, and real estate investments are illiquid, meaning they can't be quickly sold without potential losses. Moreover, managing and maintaining properties entails added responsibilities and costs. If you're intrigued by real estate income, the VanEck Vector's Mortgage REIT Income ETF could be a potential avenue to explore. Remember, while real estate income has the potential for substantial rewards, it's essential to weigh the benefits against the associated challenges and responsibilities. Number 7, Bloomberg Aggregate Bond Index. Time to navigate the realm of bonds with the Bloomberg Aggregate Bond Index. This index serves as a comprehensive gauge of the entire U.S. bond market, encompassing a wide range of bonds, from government to municipal. However, it leans heavily toward the most indebted entities. Unlike the stock market, where bigger companies wield more influence, this index is driven by those with the most debt outstanding. While it offers diversity, it's important to recognize that it's tilted toward U.S. government exposure, lacking diversification across various sectors. If you're intrigued by the prospects of this index, consider exploring funds like the iShares Core U.S. Aggregate Bond ETF. Just remember, while it can be a valuable addition to your portfolio, thorough understanding and careful consideration are essential when navigating the complex world of bonds. Number 8, leveraged loans. And last but not least, let's talk about leveraged loans. These loans, extended to companies with already high debt levels or shaky credit scores, might raise eyebrows due to their riskiness. However, they come packaged as collateralized loan obligations, a bundle of these loans combined into a single security. What's intriguing is that CLOs often feature floating rate yields, making them a potent weapon in the battle against inflation. Despite the allure of potential high rewards, it's crucial to tread carefully here. Leveraged loans and CLOs involve complex structures and heightened default risks. But for those willing to delve deeper and manage the risks, consider the Invesco Senior Loan ETF as a potential ally on your quest to protect your wealth from the clutches of inflation. And there you have it, fellow investors. The battle against inflation might be fierce, but armed with the right strategies, you can emerge victorious. Whether it's the timeless allure of gold, the potential of the S&P 500, or the stability of real estate income, there's a weapon for every financial warrior. Remember, diversification is your shield, and knowledge is your sword. So until next time, keep learning, keep growing, and keep your money safe from inflation's clutches. Don't forget to like and subscribe for more financial wisdom. And as always, if you have any questions or want to join the conversation, drop a comment below. Until next time, take care and happy investing.